Hello and welcome back to Only Pay. We'll be discussing about insurance, how do insurance company make money and how do they work. Be sure to watch to all the way to the end. If you are new to the channel, then hit the subscribe button below from our life-changing content. Well, some of us may think that there is nothing more boring than attending an insurance conference on a wet Tuesday night in Boston. And we may well be right, but if we look back to see how the industry began, it isn't as dull as it might first appear. From swashbuckling pirates to ferocious fire that ravaged the world's greatest city, insurance has held a colorful past. But how do these grey suit who sell insurance really make money, and how do the inner working of one of the most complicated facial models really work? If this question whet your curiosity, then stay tuned and make sure you watch all the way to the end. What is insurance? Well, insurance is a financial vehicle that helps spread risk by taking a risk from an individual and spreading that risk around a community. The individual is able to go about a personal and business life without crumbling from financial ruin. In the simplest term, let's look at two people. One name is Bob and the other name is Jim. Bob says, "Jim, I'll give you $10, but if I lose my cell phone, you'll have to buy me a new one." If Jim agrees, then that's insurance right there. Insurance company make money because they evaluate the risk and decide whether it is worth the gamble. Jim believes that Bob probably won't lose his phone and he'll therefore be $10 richer. If Jim finds 100 more people who are willing to give him $100 each to cover their phones, he has $1,000. If one of those 100 people loses their phones and Jim pays $100 as compensation, he still has $900. The insurance idea has been floating around since the ancient Chinese and Babylonians spread their shipping risk, but it wasn't until around the 17th century in London that modern insurance really took off. Merchant marine men and traders often hung out the coffee shop in the business district of London, and while drinking copious amount of coffee, the idea of modern day insurance was born. Lloyd's of London, the heart of worldwide insurance, was developed inside one of these coffee houses, and here's how it worked. First, you have the client. Say the client has a ship that is nervous but losing to pirates offshore, or perhaps the vessel will be destroyed in bad weather. The client approaches an insurance broker. The broker looks at the ship or pays someone to look at the ship, and they decide how much and the total value of that ship is worth. The broker then assesses the risk. He asks the client where he is traveling and what cargo he is willing to carry. With all this information, he draws up an insurance policy which he shows to the third person in the chain, the underwriter. For a cheap premium, the underwriter may exclude few risks, and for a few more bucks, he may include some extra risk. Now, there are normally lots of underwriters approached, but one will be lead, and the lead underwriter like Jim will normally takes the largest portion of the risk and sign his name first on the policy document. He knows as an underwriter as a writers his name under the risk on the insurance policy. The lead underwriter makes a major decisions when it comes to accepting the policies and will be main man to agree at any claims on the policy. Once the term of policy or agreed to it is made legal and the client is happy and the ship sets sail, but not before paying the insurance premium to the broker, who will take about 10% and pass the rest off onto the underwriter. But what should happen if pirates board the ship, steal the cargo and burn at the sea? Well, the client, if he is still alive, if he is not representative of the client, will speak to the insurance broker, and broker will visit with the lead underwriter and tell him the bad news. The rest of the underwriter, there may well be many as 20 on big policies, are told the news, and then broker must negotiate the best claim settlement for the clients or his representative. The underwriter pays the money to the broker who passes to it to client without deducting any cut. The broker makes his money once the premium is paid and will help negotiate the best claims for clients through gentlemanly honor and the prospect of future business. Now, it may be all bad news for the underwriter. If he is wise and not greedy, he may have reinsured the policy. Reinsurance puts the underwriter in the position of the client. The underwriter sells the policy into another underwriter or firm of underwriters while retaining the share of the premium. Confused yet? Well, think back to the Jim on his phone insurance. If Jim resold his $10 phone policy for $9 rather than the $10 he received, then he gets keep the dollar for each of his 100 clients, meaning he has $100 completely risk-free. Similarly, much of the modern day insurance that flows through layout of London is reinsured out to the building small insurance company all across the world. So, what started as simple agreement between the client and the broker, or Jim and the Bob, is spread across the business community who each stand to profit from the premium or take a cut of any losses. This is how insurance works. By the spreading of risk over communities, so that is how maritime insurance was born. It was developed through the need of ship owners to carry on in business should they lose everything wasteless at sea. But what about property insurance? Well, around the same time in 1666, the Great Fire of London devastated the city where modern-day insurance was born. The famous architect Sir Christopher Warren, in his Great London Redeveloped project in 1667, made sure to include an insurance office in his new plan. Now, property insurance is commonplace with most homeowners having a policy in place. Also, medical, life, travel, car and dental insurance are all commonly held policies. Even pet insurance is a major insurance business nowadays. Over time, the business model has evolved. Modern day insurance companies for fearless competitive, which is good for you, the client, as policy are priced at the lowest possible point. Companies now look at write as many policies as possible to create financial pool. They take premium of thousands of policies and invest that money in another financial product. So, the insurance underwriter may pay out more claims that they make policy premiums, but they have invested in all premiums in high interest investment schemes. So, they make their money outside of the original insurance product. Insurance is the example, is the way of creating cash flow to used in much lucrative investment.